Well, July is typically a strong month for stocks, with the S&P 500 historically delivering an average return of 1.5% for investors. Since 2000, that makes July the third best month for stocks, trailing just November and April here. Now, here you're taking a look at where we typically see some of those returns net out, and you can see where September has some sluggishness, the most sluggishness in terms of historical performance since 2000. But one of the things that we can also consider during the month of July is both earnings and then additionally, the types of volume that we typically have that is out of the system. And so ultimately, you could see more of these swings or at least more complacency. And so with some of those earnings reports that typically do kick off the season, look out for names in the financial space. Look out for some of the early technological plays that are out there. Netflix, typically one of those that has been a stronger player over the course of 2025. And so if you do have the additive performance of those major behemoths at the same time as they are setting the tone for the rest of the earnings season, then July could be one that is set up for, once again, perhaps a repeating of what we've seen since 2000. But as a solid reminder, past performance does not always equal future results here.
Not everything is hitting records in this market. There are laggards out there. One that caught my attention is Kava. Now, this is a name you covered on the IPO down at the New York Stock Exchange floor. You've talked to the CEO, Brett Schulman, many times. Why is that name, you think, been underperforming? To me, I mean, this is a company selling $10, $12, $13, $14, $15 bowls if you could get double protein. But I look at this ADP jobs report, I'm thinking maybe consumers are pulling back on all that stuff.
What we're really seeing there is this rundown from this all-time high of roughly $150 that we saw late last year, as consumers really thought, how can I get the best bang for their buck? What's the best value here? After the company really had expanded so rapidly and got into new markets, what we really saw here was ultimately this move, this shift, where they had this rapid expansion and all these new consumers turning to Kava. And then essentially after that growth, we saw a bit of a slowdown, albeit not as much of a slowdown as other fast casual restaurants had seen. But once again, we are far off that all-time high that we saw last year. Shares now about $85 per share. And ultimately what we want to see here is we want to see that rapid expansion working in their favor. We want to see new consumers coming in. We want to see retention, and we really want to see that foot traffic continue to increase, albeit although these locations are open for a while here. We're seeing a bit of a tick move higher this morning after an upgrade from one analyst on the street, and certainly that's holding on to momentum into the early innings here.
Jeb, really, the reason why I bring this up, the first day of trading for this quarter yesterday, we saw a rotation into the laggards. I mean, some of the top performing stocks kick off this quarter were those stocks that did horribly in the second quarter. What is the play here? Do you put more money into those stocks hitting 52-week highs, or do you lighten the load there and pick up some losers from the second quarter?
Yeah, I think now's a good time to be bargain shopping. It's been a really extreme move in momentum stocks. That momentum factor in the markets has been exceptionally strong year to date. One of the strongest runs in the last 20 years, really. And then on the flip side of that, kind of traditional quality, high ROE, stable businesses have really performed poorly. And so I do expect, that obviously won't last forever. I do expect it'll shift. Don't know when. The flip in the quarter yesterday started that perhaps. But yeah, I think now is a good time to be looking for high quality businesses that have underperformed recently.
But these bargain plays, Jed, these are companies I would argue maybe not as fundamentally sound as some of the ones hitting 52-week highs. And I look at the Mag 7, those names have been red hot. I look at the bargain hunters. We're getting ready to hit earnings season in a few weeks. These are the companies maybe overly exposed to tariffs, could see earnings warnings, and now their stocks get hit.
Yeah. A lot of those fundamental factors you described do exist, but valuation also plays a role in market returns. And so I think we've seen one example, CrowdStrike. It's a wonderful business. It has risen to a valuation, that's extremely high, even for its trading history. While I think it'll remain an awesome business, maybe due for a breather.
First quarter share repurchases setting a quarterly record rising more than 20% from Q4, spurred on by the top 20 companies in the S&P 500, according to data from S&P Dow Jones Indices. Here with more analysis, we've got Howard Silverblatt, who is the S&P Dow Jones Indices Senior Index Analyst here. Howard, always a great pleasure to grab some insights here with you. So what is the driving force behind some of the buybacks that we've seen at this record level?
Okay, and the items are changing. Q1 companies similar to buying cars loaded up a bit more on buybacks. They were willing to do it. They didn't know what was coming down. They knew they had to get shares, employee options to negate those. So we hit a record on there. It went up. There was a lot of expenditures, again, for Q1, led by the normal run of people. The Apples and Nvidias were up there, but also the JP Morgans, Goldman Sachs, the financials, and they're going to be the big player in Q3. But Q1 increased as companies loaded up on shares, not knowing whether or not they're going to be able to buy going forward because of the economy, tariffs, and that potential increase in taxes on buybacks, which there was talk about increasing it, not in either bill. We'll have to see how that works out in Washington over the next couple of days. But Q1 was the record. Don't expect Q2 to be, but Q3 and Q4 will be.
Why is that? For Q2, where we did see a sharp pullback in equities.
Stocks.
Right.
Yeah.
And so with that cratering, wouldn't that...
The average, I'm sorry.
No. You might already be hearing telepathically what I'm thinking, and that is, wouldn't that cratering create an opportunity for companies who were saying, all right, we were already comfortable buying back stock in Q1. Why wouldn't we continue and execute on what had already been announced in some of our repurchase plan authorizations?
Especially when the price is average, when you do it on a weighted basis, 7% less. Get a bargain on that, but they had already loaded up. They were nervous about going forward, and they spent appears maybe about 280, 281. We're getting the reports now, so slightly less. But what they did do, because the prices were less, got more shares for their dollar. You know, there's more groceries they bought because the prices were down. So that should help Q2 EPS on there because they bought back more shares, and therefore you're reducing the share count and your EPS go up. But they definitely pulled back a little. They were more nervous about the economy and tariffs, costs, their own business supply lines than they were about buybacks. And again, they were bulked up. Q3, however, we're looking to be potentially over $300 billion, a new record on there, and that's going to be led by the financials. Already seen financials, almost a dozen of them increase their buybacks and dividends, and they are pushing buybacks a lot more than dividends, even though the dividends are getting the highlights on there. So we're looking for Q3 to increase on there, but with the higher prices where we stand now, again, Q2 might have been that bargain, but it looks like they're back to buying at the high side. If they're going to be increasing right now, as long as these prices, the 6,200 level is holding. So we may not get as big of a boost to the EPS, but you'll get more buying in there. But again, you're getting fewer shares in the third quarter. And fourth quarter, by the way, also, again, market holds, levels hold, earnings hold where they're about to be. At least the estimates, we'll get a fourth quarter record on top of that quarter three, which was on top of Q1. So buybacks definitely are being favored by companies more than the dividends.
So what is, and I was just about to ask you about that, what is the pass-through effect from repurchases into dividends? Because that actually decreased in Q1 by 2.1% according to your data.
Yeah, and it's expected to decrease the next quarter as dividends show modest increase. We'll do a dividend release next week for full Q2 numbers. But basically, companies continue to increase their dividends, but they did not increase them as much. They were not as generous. They were holding back. They did not want to make that cash commitment going forward. Again, my dividends, if I pay you 10 cents instead of 9, you expect that 10 cents to continue on and eventually to be 11. Buybacks, I could pull up and down by just calling the trader. Stop buying, increasing buying. Again, the plan on buybacks is not a requirement the way dividends are and a cash flow item. So companies are going more into the buybacks now that supports their stock. Okay. The question is how much of it is going to be discretionary? They always buy enough shares to negate options, employee options, because those are cheaper. I have an option that exercises at 30, the stock's 50, the company buys it at 50, gets 30 back. It only costs them 20. When they go in to reduce their share count, it costs them that full 50, and that's controlled more by the board of directors and senior management. And we're expecting the discretionary to slightly pick up in Q3 and Q4, and it looks like it decreased in Q2. Again, we'll know that over the next several weeks as the earnings come in and the actual numbers. But buybacks companies, it's a shorter term, more control, turn it on and off. Dividends, a commitment forever.
Really fascinating data and insights. Howard, always a pleasure to grab some time with you.
Thank you.
Stock futures are lower this morning following that disappointing private payrolls report. Still, stocks are trading right now, causing speculation on Wall Street that markets could be in bubble territory. The rebound from the lows in April to fresh all-time highs at the end of the second quarter, sparking a jump in Barclays' irrational exuberance gauge, which actually measures the percentage of stocks in euphoric territory. It currently sits just above 10%, which has signaled extreme frothiness in the past. So what does this mean for investors? Joining me now, we've got good friend of the show, Sam Stovall, CFRA Research Chief Investment Strategist. Sam, good to see you here this morning, and thanks for taking some time ahead of the market open. First and foremost, I would love to get your assessment of what is being dubbed and called this irrational exuberance, with us essentially still in this ballpark of some of the all-time highs that we saw notched earlier this week.
Well, good morning, Brad. Yeah, I think people are a bit concerned because we went through a very steep V-shaped decline and then recovery. Yet history actually says that that's typically what happens because we went from a new all-time high to the minus 10% threshold in only 22 calendar days versus the more normal 80-plus days. That implied that this decline was going to be swift, shallow, and the recovery would be quick at hand, which is exactly what we got. Instead of the 4 months that we normally take to go into a correction and then another 4 months to get out of that correction, those numbers were essentially cut in half. And actually, because people are so concerned, I think that history again will remind us that we tend to advance another 10% following the recovery of the old high. So, while we can always see some sort of digestions of gains, I think the overall trend remains upward.
And so with that in mind, if we're looking at an overall trend that remains upward, what perhaps is the major kind of additive to the mindset, and how far out investors might be looking through some of the trade deal negotiations, through a bill that's working its way now back through the House, and then, oh yeah, we're trying to figure out exactly what companies might say during earnings season in the next few weeks here as that kicks off?
Sure. Well, I think that initial reactions are like dropping a ping pong ball on the table. The first response is the greatest, and then subsequent ones are more muted. And that's what we have seen regarding the tariff situation, regarding the one big beautiful bill, et cetera. And also because we had a worry that we were headed for recession, and bull markets don't die of old age, they die of fright. And what they're most afraid of is recession. But because of the recovery, the old adage of prices lead fundamentals implies that maybe we're seeing a near-term bottom in terms of earnings projections. Q2 results are now expected to be up only about 2% versus the near 10% advance that was expected at the end of 2024. So I think with the bar set so low that we'll probably end up seeing actual results exceed end of quarter estimates once again, which will make the 63rd quarter out of the last 65.
You know, that's so interesting, and I was discussing this yesterday with a few of our guests, and would love to get your thoughts on this too, since you raised the fact that this earnings growth rate could be one of the lowest growth rates that we see since Q4 2023, according to FactSet, if it does come in at this 5% earnings growth rate for Q2 for the S&P 500. Can you make sense of the fact that we've got that in one hand, and then on the other hand, you've got forward 12-month PE ratio sitting for the S&P 500 at 21.9, which is above the 5-year and the 10-year average right now.
That's right. Well, I think your first thought is that FactSet's estimate for Q2 is above 5%. S&P Capital IQ estimates, which is what we use, is about 2%. So there is no FASB designated definition of operating earnings. Most people simply call it earnings before bad stuff. But still, the bar is set very low. And as my father used to say, rarely do you injure yourself falling out of a basement window. So I think we probably will be surprised to the upside when Q2 results are completed. But in terms of the PE ratio, you're absolutely right. If you look back over the many years, it is elevated, but I think that we're likely to see these earnings estimates increase as time goes on, in a sense, to match what happened with prices.
Sam, we're marching to the opening bell here. We got to leave the conversation there. Great to see you as always.
Thanks, Brad.
Thank you.
Let's welcome in here Michael Reynolds, Glen Mead VP of Investment Strategy. Michael, great to see you. Want to pick up there, Michael, what we were just talking about there, which was President Trump's big, beautiful bill, Michael. I'm curious, let's say, Michael, that does get punched through here. You think the stock market would react and respond how, Michael?
Yeah, so we're looking at some pretty big stimulus out of this bill. We've still got some fireworks in Congress here, maybe a little early for 4th of July, but fireworks nonetheless on some of the details, exactly how we're going to get this through before the 4th of July recess. But overall, we do think something's going to pass, and the details actually don't really matter all that much. But what we're looking at is some decent fiscal stimulus out of this. Yeah, it may not match what we saw in the TCJA just back in 2017, but we're still looking for 2026, possibly as much as 0.8% tailwind to economic growth from the fiscal stimulus alone in this bill, which can help offset some of the impact of tariffs on the other side. We're looking at how markets are digesting this, and there are some pockets where they're pricing this in perhaps a little bit probabilistically, but once Congress is able to get over these hurdles on some of the details and get this moving to somewhere that's probably more workable for both sides is where you're going to start to see markets really start to price this in more fully.
How do you think the bond market will react, Michael? Lots of talk, and you know this, about this bill and what it means for our debts and deficits long term.
There's quite a bit of chatter that, neither side of the political spectrum is really all that worried right now about impacts of debts and deficits, at least when they have power, at least. We don't think that the Treasury markets are going to go too crazy on this. We saw a little bit of it just a few months ago with the downgrading from Moody's. That was short-lived. Not a lot of new information here. I mean, the details of the bill and really the overarching structure is really well known. And to basically flip the script on how Treasury markets are going to digest this based on them just passing what's already sort of known is sort of difficult to see from here. We'd expect that Treasury markets are going to digest this, but longer term, debts and deficits are something that Congress is going to have to get under control. Whether that moment is now or even this year remains up for debate.
And Michael, so the big, beautiful bill, one headline today, right? But we're also tracking this trade deal with Vietnam that the president announced. We do have this July 9th deadline out there, Michael, but it kind of feels like the markets have decided, you know what, Trump has backed off the kind of maximalist peak tariff threat, and we can kind of live with whatever's going to be imposed here. But what do you make of it?
Well, everyone loves a good 4th of July sale, and that 46% tariff that was going to be imposed on Liberation Day on Vietnam is now looking more like 20%. And so this is really informative for, I think, a couple reasons. Vietnam in particular is probably one of the countries with the least amount of negotiation leverage here. We have a large trade deficit with them. It's actually their exports to us are a large part of their economy, so they really had to come to the table with some concessions. But what it does tell us is that the administration is not going to insist on some of those eye-popping Liberation Day tariffs with quite a few of our trade partners here. It may be indicative of what we could see of some sort of peer nations in the area like Cambodia, Laos, or Malaysia, where we have a similar setup, large trade deficits that end up being a large part of their economy. You could see some asymmetric trade deals. The details matter. We got to kind of read between the lines on the Truth Social post here before we really figure out exactly how this is going to shape up. But it does take off the table on the margin some of, again, those eye-popping numbers we saw on Liberation Day that gave the market its biggest worries at the time.
Michael, one other thing I'm just curious to get your take on is dollar weakness. It's another important theme for investors. Dollar was down about 10% in the first half of the year. Do you see that weakness continuing, Michael? Is it bottoming here? And what does it mean for the market?
Dollar's coming off really just a decade of unrelenting strength. Even if we weren't seeing some of the trade policy stuff coming through this year as it has been, at some point, a little bit of a relief from that rally was relatively warranted. And the trade aspect here is really kind of helping that here. We do think we can continue to see dollar weakness through the end of the year. We're not calling for major changes to the reserve currency status of the dollar. We think those concerns are overblown. But could you see marginal weakness that gets the dollar on a purchasing power basis relatively more in line with its historical record? We certainly can see that. And so when we're talking to our investors about how to take advantage of this, you got to make sure you have non-dollar denominated assets in your portfolio. And in a lot of cases, international equities really fit that bill because they're a productive asset. And if you don't hedge the currency, you can actually benefit from a weakening dollar.
Michael, great to have you on the show today. Thanks so much for joining us. Appreciate it.
Have a nice holiday.
Scott, great to see you. So let's talk about this market. You talk about the positives, Scott. Trump wants a deal on trade. You say taxes likely going down, deregulation, AI-powered productivity. It sounds great, Scott. So walk us through the negatives, Scott, as you see it, or the potential negatives.
Yeah, look, and I think Barbara did a really nice job sort of summarizing kind of what's going on right now. We agree with quite a lot of what she's already said. The negatives are kind of the obvious stuff. I mean, look, geopolitics is always going to be out there, but it doesn't really matter. The ferocity with which the market disregarded what happened in Iran, took even me by surprise. And I've been in some of this faded Middle East stuff for the better part of 30 years. But that was fast even by my standards. That's always going to be out there. And then, as Barbara highlighted earlier, labor market is slowing. Things are slowing, but there's a difference between slowing and slow. And it is, we're by no means in any sort of bad stretch right now. And the low-end consumer is feeling a little bit of a pinch, but almost tautologically, the low-end consumer doesn't really drive the bus economically in the United States. And so it is, it's a little bit of a challenge, but it's not that bad right now. So for us right now, this is kind of a 6 out of 10 economy, and probably a 7 out of 10 market outlook. So we're not going gangbusters, but it's not really, there's not that much out there to worry about right now if Liberation Day tariff levels don't end up prevailing.
How would you broadly characterize valuations here, Scott?
Valuations are in the neighborhood of fair. Look, the high value, high earning stocks are going to continue to lead this market. I mean, everybody worries about the top of the market. Everybody worries about concentration. Everybody worries about, are we going back into like the 1999, 2000 sort of levels of sort of bubbly Nasdaq-y sort of performance? That's the parallel everybody wants to draw. And I think we're more in like the 1994, 1995 period. This is a period where the tech is still going to lead, and there's going to be those high valuation stocks that are going to continue to lead. But those high valuation stocks are expensive for a reason. They have 30, 40, 50% margins in some cases, and they just make money hand over fist. And so high return on equity plus high PEs doesn't mean those things are a sell. It means they're actually still a buy.
In terms of other places you see opportunity, Scott, against the backdrop you kind of laid out there, infrastructure, you say, walk us through that.
Yeah, infrastructure to us is pretty interesting right here. I mean, you're starting to see a little bit of a bid to it, really just over the last couple of weeks. The big beautiful bill, will probably help on some of this because it'll help. It'll basically make CapEx free, and not free, but deductible immediately, which is a really big deal in terms of producing more stuff here in the United States. And then you have the entire AI power generation trade that kind of took off and then cooled off. But at the end of the day, we're going to need to produce quite a lot more power in the United States than we do today. And all of those things all tie into infrastructure being a pretty interesting place right here.
How about in terms of, Scott, looking ahead, you want to say U.S. focused, or would you also be eyeing opportunities overseas here?
We actually like overseas quite a lot right now, much more than we have in a while. This has been a sort of a standing thesis for us most of this year. A lot of it has to do with the dollar. We do have a modestly negative view of the dollar right now, and this is stemming more from flows than it is from either interest rate differentials or growth differentials, which are really the other two things that can typically drive currencies. But it flows right now in terms of just hedging activity that we're starting to detect out of foreign holders of U.S. financial assets. Foreign holders of U.S. financial assets, or foreigners, hold $30 trillion worth of U.S. stocks, bonds, and treasuries. And if it becomes in their interest to begin to increase their hedge ratios on that means they have to sell dollars, and that's just downward pressure on the dollar that we have seen so far this year, and we think we're going to continue to see as portfolio flows sort of continue along that line. That's a big tailwind for international stocks. And so while you don't have tech outside of the U.S. and like outside of China and the U.S. really. So I'm thinking specifically about Europe. We don't have some of the drivers of the market we think, or drivers of the economy that are like really outside of the U.S. But for the next 6 to 12 months, that currency tailwind that you're going to get by investing in international markets, we think is going to be pretty strong.
Well, we're officially at the midpoint of the year, and that milestone is a great opportunity to look back at calls investors and strategists made back in January. Joining me now, we've got Jonathan Boyer, who is the Boyer Research President. You joined us back in January. You had 3 picks from your Forgotten 40 list. All names you predicted would outperform in the year ahead, and all 3 have outperformed the S&P 500 so far this year. They are down today, but of course, it's the longer term that we're looking at here. And so, as you're thinking through and taking an assessment of those names and how they have performed here, walk us into your thinking for the second half of the year. Are you leaning further into those names or rotating?
First, thank you for having me. And yes, the Forgotten 40 is the 40 best ideas for the year ahead. Uber, Markel, and Atlanta Braves Holdings, they all had short-term and medium-term catalysts. They've all done nicely, but we still think there's more room to run in each of them. Uber is an extraordinarily interesting name. And finally, one of the things that I think is helping the stock is how muted of a response the robo-taxi event Tesla had in Austin was. Investors are finally starting to realize that autonomous vehicles is a beneficiary, not a threat, and we think they'll continue to do so, although there could be fits and starts along the way as Elon Musk makes his announcements, which generally have not come to pass.
Well, to your point, yes, and I agree on that last point. But as we think about the reaction, the stock price correlation to these events that Tesla holds, how big of either a weight or maybe just a further proving point for what Uber has talked about, even since they've gone public, and that autonomous driving will bring down their operating cost per mile, and thus that's something that they have to invest heavily in over the course of the next several years. Do you see us finally hitting an inflection point for Uber as consumers become more, more familiar with these types of services that are going to offer them driverless vehicles and driverless rides?
Well, two things that are interesting with that. One, if you look at the stock market reaction on Elon's announcements, they've gotten less dramatic over time. I remember a year or so ago, the stock was down probably 15-20% in a month over these fears. Now it's much less so. And in terms of the investing part of it, the beauty of owning Uber is it's really a capital light model. Waymo, Tesla, all the other ones are the ones investing a significant amount of capital. Uber is just going to be basically collecting a toll, which is a great business. We'd much rather own that than the capital-intensive, heavier business.
And then additionally here, let's walk through some of these small caps that you're identifying and really believing in for the second half of this year. Where are you seeing those opportunities?
Yeah, it's broad-based. Small caps are probably one of the cheapest areas of the market. Generally, they do extremely well after the Fed stops a rate hiking cycle. That has not come to pass yet. And they're also insulated from, or it could be a beneficiary from tariffs as people invest more in the U.S. or companies do. One of the ones that we really like, and we discussed in your show last time, is Atlanta Braves Holdings. There's 2 catalysts, one short and one medium term. The short-term catalyst is the 2-year spin-off milestone from that they have is set to expire in July, which means they can be sold without any adverse tax consequences. And it's controlled by media mogul John Malone, who is not an emotional owner. And we think he'll take advantage of these high prices in these trophy assets to sell the team. Plus, in 2027, there's a new tax law that comes out that gives publicly traded sports team, puts them at a significant competitive disadvantage to their privately held peers. And I think it'll force companies like Atlanta Braves Holdings and other publicly traded sports teams to go private.
And as we're thinking about some of the small caps play, and really as you were kind of diving in on this specific play here with the Atlanta Braves holdings, I wonder more broadly across small caps right now if it's wise for investors to be stock picking with small caps, or if you go towards an index or perhaps, an S&P 500 or an S&P 600 rather that has a profitability filter on it.
Yeah, I mean, listen, we're biased. We're stock selectors. I think if you're able to do the research and pick the right stocks, that's where you want to go and find these kind of one-off names like Atlanta Braves Holdings or Scott's Miracle-Gro or some of these others. If not, I think investors over the long period of time probably will do fine in the S&P 600 index, but I think stock picking can do extraordinarily well over the next 3 and 5 years, especially in the small cap arena.
All right, you were talking about the Braves, and that had me looking up the freeze from Atlanta Braves games. He's got to start winning some of these races, man. Jonathan, thanks so much for taking the time.
Thank you.
Meta just hit a record high on Monday. Nvidia's 17% surge the past month has it knocking on the door of a $4 trillion market cap. My question is this: should you own both Meta and Nvidia in the face of their face-ripping rallies? Chad, I'll start with you here. If you had to pick one of these two names in the back half of the year, which one is it?
I would perhaps go with Meta. It seems as if they have a continual competitive advantage, and it doesn't look like they're going to be in the crosshairs of the DOJ anytime soon. With that said, I'm sorry, I'm going to pivot. You want to own other companies within the Mag 7 that perhaps their valuations have been drastically discounted.
Brooke, you mentioned earlier on this new super intelligence unit for Meta, and it sounds great. It's led by Alexander Wang, who led Scale AI. Sounds exciting on paper. What I can't figure out is how is this going to impact Meta's earnings this year? I don't know if it will.
Well, what Mark Zuckerberg says, that this is a necessity of the company. Of course, Mark Zuckerberg, the founder, the CEO of Meta, formerly known as Facebook. But what he really said here was that he believes that this is the beginning of a new era for humanity, and he's fully committed to doing what it takes for Meta to lead the way. Of course, Meta looking to get ahead in this AI revolution that so many companies are looking to jump on board. And as you mentioned, he's brought in top executives from Scale AI CEO Alexander Wang. He also brought in former GitHub CEO, as well as Nat Friedman there. He also brought in 11 new hires who are really focused around this AI trade. And he's really saying here, investors really need to jump on and understand that this is not a want, a desire. This is a necessity for the company to compete in the near term and really long term here, Brian.
Al, you know who's really driving the future of humanity? That's Jensen Huang and Nvidia. Make the case for Nvidia.
Yeah, Nvidia, baby, the godfather of AI here. And we've seen mega cap stocks, especially Nvidia, outperform. You were just talking about the share price move that we've seen up about 15%. We are nearing closer and closer to that $4 trillion market cap. And just a little context here, Brian, if Nvidia hits those levels, that would be valued 36% higher than the entire British stock market. That's the FTSE 100, and just 18% below the total value of Japan's Nikkei 225. So that just goes to show the sheer enthusiasm around this company, around this stock. Of course, earnings, that's huge for this company. If we see any deterioration on that front when it comes to demand, along with the hyperscalers, if they hint at any sort of demand headwinds, Blackwell, obviously a big focus for a lot of those investors. If we see that, we could have a pullback in the stock. But so far, earnings have been relatively steady, moving to the upside. And I think that is the big next test for Nvidia. But I'm bullish here, and I think that Nvidia is going to continue to see a lot of those gains.
The S&P 500 is entering the second half of the year after notching several all-time highs. But some technical indicators show that the rally could be under pressure as stocks enter overbought territory. So what does this mean? Well, take a look here at the Relative Strength Index, the RSI, which shows that stocks are at their most overbought since July of 2024 here. And so one of the things that we can take into consideration with some of these overbought levels are the trades that continue to be crowded into as well. And one of the most popular long trades continues to be long mag 7. However, in the conversations that we've had over the course of this week, what is key, even at these all-time high levels, is to look for more breadth in this market. If we did see more broadening out into the other 493 S&P 500 names, oh yeah, and all of the other areas of the market that have not gotten the same type of fanfare as those and next to the AI trade, that's what analysts and investors are going to be looking for over the rest of the course of the summer, where we were already anticipating some volatility, some chop on lower volume, and then additionally you have the additive of some of the major events, two of which kicking off July. One, the tax bill, and then two, of course, the post-Liberation Day and now Liberation Day 2.0, where we're expecting even more of the talk around trade negotiations. Now, a downside risk to the market, of course, right now is if we don't see any of these trade deals come forward, where the White House had already talked about looking for multiple deals to come over the finish line and good faith negotiations that were moving forward. From the EU, it sounds like they're willing to accept some of the tariffs that the US and the counterparts and trade representatives are putting forward. But the larger consideration there is if we see more pushback and more tough talk on trade, how that could potentially rattle markets, especially if you continue to hear some of the rhetoric targeted towards Asia-Pacific countries that have the larger outsized GDP footprint. Think China, think Japan. And so that's where we're going to be continuing to track how stocks are moving in reaction to some of those headlines here, especially if we do have weaker than expected volume that could catapult or leg up, leg down some of the activity, especially as we've just recently got back to these all-time high levels that were unseen since February of this year. But some of the strength that we're seeing also may be tested going into this earnings season, where hopefully we'll get a little bit more clarity on outlooks. This coming after a quarter where tariffs were the most repeated word over the course of the S&P 500's earnings reports. Steve, I want to pivot and get your thoughts on the bill. Is this a tradable event for investors, and how would you rank this in priority of portfolio positioning and how traders should be thinking about it?
Well, I think a lot of it has to, I'm going to take my cues largely from the bond market on this one, because what I fear, it would be a real steepening of the yield curve. We saw the 10-year perform pretty well into quarter end. Bond traders are not immune from window dressing either. We do sort of see bond moves kind of culminate around quarter ends a lot of time. Yeah. And if there are real concerns about the sustainability of the debt and deficit, you would see that reflected in higher 10-year yields relative to shorter rates. I think I just saw a headline go by that Powell is concerned about the sustainability of the debt under the new deal, under the new budget deal. And so that's what I'm watching, because you're also seeing a lot of times where the dollar is selling off even as rates are slightly higher. All things being equal, a higher rate should help a currency. And the US actually has relatively high rates compared to the rest of the world, but yet the dollar had one of its worst halves in decades. Yeah. And so it's telling me that money is sort of leaking out of the US, whether it's stocks or bonds. That's why I look to bonds, because if they're starting to freak out, then we kind of have to worry about the sustainability of the deficit and the debt.
That's so fascinating, and what you were mentioning in money leaking out of the U.S. at the same time where you have the administration that is touting some of the international deal making that, as we were watching the international trip that President Trump took to the first one of his Trump 2.0 presidency, talking about where there are some of these major entities, organizations, both on the private sector side that are trying to get into certain regions of the world, and those regions of the world that are looking to invest in the U.S. All this considered, we're still looking at some of the record high exposure that foreign countries have to U.S. bonds right now that I believe we're still sitting at. So, just help us make sense of that. Why is it either net good or net bad if we did see some of that international holding of U.S. bonds right now?
Our biggest single export is our debt. Basically, to put it oversimplification on this, sure. we buy stuff from the rest of the world, and they buy our debt to finance this, because our savings rate is not particularly good in the U.S. So we buy stuff from abroad, and it's sort of to balance out the equation. Sure. They buy debt. The problem is it doesn't take much. If there was just even a marginal decline in the amount that they're willing to refinance or continue buying, that would get hit because I don't know that there's, the domestic demand with which to replace that. In theory, if the trade deficit starts to come down meaningfully, we don't need to replace it as much. But then if the actual budget deficit goes up, then we do need to replace it. So there's a lot of moving parts. Bottom line here is, the stuff that was mentioned in that Middle Eastern trip were long-term investments. They're going to play out over a lot of time. Refinancing government debt plays out continually. There's auctions almost constantly. So I'm not going to say that some of these countries are going to do anything, to really be spiteful. I mean, if China wanted to cause a little bit of short-term chaos, they could just sit out a bond auction one day and all of a sudden, watch the chaos that ensues. But it would hurt them as well because they own so many. They and the Japanese own, trillions of U.S. dollar debt collectively. And so I don't think there's not a high risk of it, but trading occurs at the margins. And so if you see marginally less demand, it does have an effect on prices. In the case of bonds, prices go down, yields go up if people sit out.
Well, as of this morning, investors still pricing in the first rate cut of 2025 to come in September. Fed Chair Jerome Powell, speaking earlier today at the European Central Bank Forum, said the Fed will remain paused until seeing the ultimate impact of President Trump's tariffs.
In effect, we went on hold when we saw the size of the tariffs and essentially all inflation forecasts for the United States went up materially as a consequence of the tariffs. So we didn't overreact. In fact, we didn't react at all. We're simply taking some time. As long as the U.S. economy is in solid shape, we think the prudent thing to do is to wait and learn more and see what those effects might be. And again, they haven't really shown up. So for now, we're waiting.
So with the July 9th tariff deadline bearing down just 8 days away at this point, pressure from President Trump and a week of economic data ahead, what should investors be expecting from the Fed? I want to bring in my contributor for the hour. We've got Steve Sosnick, who is the Interactive Brokers Chief Strategist. Steve, great to have you back here in studio.
Great to be with you, Brad.
Let's talk through this. What should investors be prioritizing as we go into the back half of this year, kicking off with everything from trade deals that are anticipated to continue to be negotiated, hopefully netted out in some form or another. Also, a Fed that is trying to be looking through and be data dependent as we get this week of economic data on the jobs front that they're paying close attention to. Oh, yeah, and then earnings season starts in a couple weeks.
Let's try to lay them out, in terms of chronological order,
Sure.
and I hope I can do this correctly. We've got job numbers, as you mentioned, on Friday. Market's always looking to them. The jolts were a bit of a jolt this morning. I think that's, that works against the concept of labor market weakness, but we'll get a clearer picture on Thursday, I should say, not Friday, because it's the holiday. In theory, the budget bill should be signed at some point, but there's the back and forth. I don't, talk about the not wanting to see the sausage being made, but there's a lot of stuff going on behind the scenes. It's too difficult to figure out exactly how that shakes out, but I think the basic framework is there. Then we have the tariff moratoria next week.
Right.
Do those expire or do those get pushed back again? Again, the market seems to be looking through that and thinking that this will all be fine. There'll be deals done, or at least there's enough negotiations to give cover to the idea that they'll be pushed back. So that's there. Oh, and then guess what? It's earnings season all over again.
Right.
It seems like we never left one, but we have that again. And one of my fears is some of the stocks that we've seen recently that have beat on top line, bottom line, and guidance, and then still get whacked. We saw it in Progress Software today, and we saw it in Micron a couple weeks ago. That is a concern going forward. And then you've got lurking in the background is what is the Fed going to do? And Powell just said in the gathering of central bankers in Portugal that he doesn't expect any tariff effects to really be seen till the summer. So he's very much in wait and see mode. The market may be a little bit ahead of him by pricing in a full rate cut by September. But then again, markets have always been ahead of the Fed. Remember the 8 rate cuts that we were supposed to get in 2024?
Yeah.
So let's all see how this shakes out. So many moving parts, but yet we see a very quiescent market, VIX, 17-ish. is not expecting too much right now.
You know, as we're thinking through how the markets are looking out into the future and anticipating that all of these matters will come to fruition in some facet or another, it's just a matter of, for the checklist of trade deals, what those deals actually look like in the details as well. It seems like the markets are already kind of factoring in this effective average tariff rate of around 10% here, which is still well higher than where we began the year at an average about 2%. Jennifer Lee from BMO was reminding us yesterday here. And so if the markets are already factoring all of this in, how far out into the future do you think the markets are looking past much of what is a headwind, at least as of right now, on a concern checklist for investors?
I'm actually going to take it the opposite way. The market doesn't look. The market is looking like, you know, at itself. It's very self-referential right now. It's all. I categorize this as a mix of MOMO and FOMO. It's all about momentum and, to a certain extent, FOMO, of fear of missing out. Which is why, yeah, you've got a relatively broad rally, but really the gains are concentrated in the stuff you'd think it's concentrated in. When I broke down the first quarter performance, you know, basically S&P, and I broke out the SGX versus the SVX, the growth components of the S&P 500 versus the value components. The difference, the growth outperformed the S&P as a whole by about 8 percentage points. The value underperformed the S&P as a whole by about 8 percentage points, which means they, you know, the value underperformance was about 16 or 17 percentage points altogether. That's huge. That's telling you that all the action is in the growth sector. An SGX and NDX move essentially in lockstep because it's basically dominated by the same companies.
Does MOMO and FOMO mean that we're due for a prolonged melt-up in the markets, from what your assessment is?
We're in the midst of a prolonged melt-up. That's kind of what we're seeing. The question is, what gets it to stop? And you never really know what that is. I mean, this morning, you know, did you have the president threatening to deport Elon Musk on your bingo card? No, and which is why we saw a little bit of red. That and the fact that yesterday's close was basically just pure window dressing. But you know, these are the kind of things. So that's why I looked sort of toward earnings season, because the idea of companies doing well and yet not getting rewarded for it, that's the sort of thing that gets in the way of a momentum trade.
Well, job openings increasing unexpectedly in May, rising to a 6-month high at nearly 7.8 million openings, suggesting more confidence in the labor market ahead of Thursday's jobs report. While U.S. manufacturing remains somewhat sluggish in June, suggesting President Trump's tariffs are having an impact on business. Manufacturing PMI rising to 49. So, some improvement from the prior month, but we're still seeing that gauge below the 50 mark, indicating contraction. So here to discuss what it all means for the U.S. economy, we've got Paul Grunwald, who is the S&P Global Ratings Global Chief Economist here. Thanks so much for joining us on set.
Good to be back.
Absolutely. Also with us for the conversation, we still have Steve Sosnick of Interactive Brokers. So as we really think through the data that we've seen come through and whether or not it's starting to line up in a trend fashion that would then pivot the Fed, or at least get them firmly into cut camp, are we close, or how many data points away from making that trend are we in your reading?
Yeah, we think July's probably too early for the Fed to make its next cut. They'd have to see some bad employment numbers and then some weaker inflation numbers. And you know, our baseline's still got this gradual slowdown in the U.S. this year, but we don't think they're going to be ready to flip the switch in July, at least what we've seen the last couple of months. But as this morning's data show, we're still a little bit in this bouncy area where things are a bit all over the place.
So Steve, does that set us up for September then?
It could, assuming that we know what's going on in terms of tariffs and we know what the budget effects of the deal are going to be. It sounds like certain members of the board are a little trigger happy. Others are not. Powell seems not to be. Bostic's not voting, I think, this time, but he seems not to be. So there's mixed commentary. Again, as I mentioned, the market tends to get ahead of the Fed a bit. But you know, I'll leave the real underlying economics to Paul.
And when we think about those underlying economics right now, where is the Fed seeing the most area of concern at this juncture, especially as they're hearing from everyone from President Trump chirping at Fed Chair Jerome Powell, all the way through to some of the major investment institutions that are saying, okay, yeah, now we're starting to think that they should be cutting as of
Yeah, well, the big issue is the uncertainty. It's not, as we've said, it's not really the tariffs themselves. Those are a negative issue, but it's really all the uncertainty around tariffs. We've got another date coming up on July 9th, which is the pause on the April 2nd tariffs, and we just don't know what's going on. And when people don't know what they're going on, they slow down investment, they slow down spending, they slow down capital allocation, they slow down M&A. So we've still got this overhang on the market, and we'll see what happens on July 9th. We heard some noise about Japan this morning, but as long as that overhang is there, we still think we've got to sort of dampen sentiment everywhere, basically.
I want to stick with you for a second, Paul, because I was taking a look at one of the notes from Apollo chief economist Torsten Slok this week. It said when FOMC members produce their forecasts ahead of Fed meetings, they are also asked how they view the risks to inflation and unemployment. And one of the net takeaways that this is a Fed that is worried about stagflation right now.
Yeah.
Why is stagflation now one of the core worries for the Fed, and to what extent are we placing probability around the reality of stagflation playing out?
Yeah, we're not really in the stagflation camp. We are going to get a rise in inflation rates because the tariff's going to lift the price level, but that's not really a driving force on inflation higher. So I think we're still in this kind of traditional world. The signals are very noisy, right? Because you are going to get a rise in inflation and a rise in unemployment, and that's kind of stagflation. But we think we're going to look through, and the Fed's probably going to look through the jumps from the tariff versus any underlying inflation trends. We still think the next rate's down.
How can investors position their portfolio if we did see stagflation play out? What are perhaps the stagflation positioning in a portfolio?
Stagflation is kind of like the worst of all scenarios.
Yeah.
No, I'm with Paul. I think technically, if you're looking at higher prices and a slowing and a stagnant economy, that's stagflation. But I think when the term gets thrown around, we're nowhere close to what true 70s style stagflation is. And correct me.
Yeah, can I jump in on the back of that? And the other thing we're seeing now, the positive thing that we didn't see in the 70s, is productivity growth. Remember, the last couple of years, U.S. has been hitting the ball out of the park relative to the rest of its peer group. Strong productivity growth, strong new business formation. So that's not a recipe for sort of supply side, weakness. That's really a stagflation issue. So I don't think that's really on the table right now.
You talk about that productivity growth, and one of the questions that we've had for several jobs readings now, perhaps for a couple dozen, is where we might see AI start to show up within that productivity growth as well.
Yeah, that's kind of a big, even economists, even really smart economists, have got this huge range of outcomes, right? The current Nobel laureate's close to zero for the effect of AI on growth.
Interesting.
Some of the more, bullish guys on the street are 1.5% increase in growth over 5 years. Some of the, the IMF, OECD are in the middle. We just don't know. We know it's positive. We don't know when it's going to show up in the data and for how long it's going to last. But it's got some potential. I wouldn't be watching kind of the month-to-month, labor market data to see if we're going to see AI. I think it's just a longer-term kind of trend thing, but definitely positive.
Even if positive for productivity, is it still positive for overall headline jobs growth?
Yeah, well, that's the thing. You can have productivity go up by hiring fewer people or expanding the pie and hiring more people. So that's the big thing with the AI. Productivity is going to go up, but is it labor enhancing or labor substituting? It's probably going to be a little bit of both. We're going to have to tease those out. But again, that's a multi-year thing. That's not we're not going to know the answer to that by the end of 2025, right?
Look, we just want to know all the answers all the time.
I know.
That's why
I'm sorry to disappoint you, Brad.
Paul, great to have you here. Never a disappointment at all here. Thank you so much for joining us in the studio.
Let's welcome in here Jason Barcima, Halo Investing President and co-founder. Jason, it's great to see you. Let's start with the big news of the day, Jason. Senate does pass the big, beautiful bill. Now, of course, goes to the House. I'm just curious, Jason, how are you thinking through that? Market implications? Was this all priced into the market, Jason?
Yeah, I think a lot of it is ultimately priced in. I think that a lot of people thought that Trump was going to be able to get this bill passed. But it's really about setting up for the second half, right? And as your previous guest just talked about, what are the earnings that we're going to see in the second half? What are really the tailwinds that we're going to see? And most importantly, what's the central bank going to do, Josh? And I think that's what the market is really looking for, at least in the back half of this year.
Do you think, Jason, we see with the big, beautiful bill, would you expect to see pushback at some point from the bond market? There was a lot of hot talk, and for good reasons, debts, deficits. Although I'm looking at a 10-year here at 4.25, Jason.
Yeah, and you saw a big backup today from, partly because of the big, beautiful bill, but I also think part of the economic data that came out this morning with JOLTS job data. Ultimately, jobs are looking good, the consumer is looking pretty good, and it all depends on what Jay Powell wants to do. You've got expectations across the board of maybe 3 rate cuts, maybe no rate cuts. And I think there's an argument for something right in between. My personal belief is the Fed should really be focused on at least 1 rate cut to give us some wiggle room. But ultimately, the big, beautiful bill can be very supportive of further economic growth. I think the trend in AI is here to stay. And you're also seeing a broadening out of the rally, right? Over 70% of companies now are trading above their 50-day moving average. And that's something that we traditionally haven't seen over the last 18 months. So for me and my perspective, that's something to be really optimistic about, over the course of the next 12 to 18 months in the market.
You mentioned earnings there, Jason. Q2 earnings season is on deck. Your expectations, Jason, is that going to be a positive catalyst for the market?
I think so. I mean, especially with jobs in the consumer right now and with some more fiscal spending, it should be pretty healthy for earnings expectations. What I'm really looking at too is where are there the pockets of opportunity? Clearly, we've seen a very pronounced growth in a small set of names, traditionally the big tech names. But as I mentioned, you're seeing a broadening out of that rally. And it's not just within the United States. Look at the rally that you've seen overseas. And I think there's a lot of tailwinds when you're looking at Europe. But whether you're looking at the United States or Europe, whether you're looking at earnings or what the Fed's going to do, there's going to be volatility, Josh. And that's what investors need to be prepared for over the course of the next 6 months. And we saw that in Q1 and Q2, obviously with April and Q2. I think the trend is going to be up, but the path on that upward trend is going to be really volatile. Investors need to look for ways to be able to play defense within their portfolios and protect the portfolios while being able to take advantage of potentially some buying opportunities we're going to see over the course of the next 6 months.
And Lou, I want to get you in here as well. Just about that Q2 earnings season, Jason, broadly speaking, expecting good positive things. Is that what you're looking for?
Yeah, I'm looking for that. We're talking about the unmagnificent 493 actually reporting much stronger growth than they have traditionally. Mag 7 still the big driver. But I'm like Jason, I think you need to be opportunistic. This is not a time where you can index per se and just buy the big indexes even though they're hitting all-time highs. You got to look for pockets of opportunity. Energy is the most underweighted and undervalued sector in the S&P 500 right now, trading at about 15 times earnings. That's interesting to me. I also think you got to think of second derivative plays in AI. If you look at the Q1 GDP report for the US, it was terrible, right? Down a half percentage point, but there was a full percentage point of growth coming from AI. That's a factor, a growth factor that I don't think many people have calculated yet in the back half of the year. So not just names like Nvidia, find those solution providers. It's not just the chips, it's the platforms that deliver the AI services that could be more interesting in a market like this.
Jason, when you mentioned opportunities overseas, I'm just curious, places like Europe, what interests you about that? Is it purely a valuation call? Is it the stimulus they're providing?
It's a little bit of everything. To your point, Josh, if you look at European stocks, they trade at about a 35% discount to US stocks. So historically, that's quite wide. But if you zoom out on the macro issues, because ultimately trading at a discount to US stocks mean nothing when it comes to investing. It's really about what are the macro tailwinds behind it. You've got central banks lowering rates. You've got healthy corporate balance sheets. And obviously, you're seeing a tremendous amount of fiscal spending. You're seeing defense spending compared to spending that happened during World War II and ultimately World War I, and that's not going to stop. And so with all of those different tailwinds, plus a weakening dollar, so even for American investors with a weakening dollar, it may be advantageous to go and look overseas. I'm just saying ultimately do that with some downside protection in it, because we saw a prolific rally in Q2 in European stocks. We all know that, but I still think it's early within that game. Back to Lou's point, ultimately, though, there's pockets of opportunity here, and I think that investors should also be looking at small caps. Small caps are trading at a tremendous discount against large caps, and I think there's some pockets of growth and opportunity in the small cap space.
Jason, great to have you. Great to have you on the show. Thank you, sir.
Yeah, thanks, Josh.
Federal Reserve Chair Jerome Powell, speaking in Portugal on Tuesday, told a gathering held by the European Central Bank that the U.S. Central Bank may have changed their plans for the fight against inflation, if not for the president's trade deals. Yahoo Finance's Jennifer Schonberger has more.
Hey there, Josh. Fed Chair Jay Powell didn't take a rate cut off the table for the Fed's next policy meeting later this month. And as you said that if it weren't for tariffs, the Fed would already be cutting rates. Listen.
And on the data, and we are going meeting by meeting. I mentioned, how I'm thinking about that, but I wouldn't take any meeting off the table or put it directly on the table. It's going to depend on how the data evolve.
Powell noted that a, quote, solid majority of the Fed's interest rate setting committee thinks it will be appropriate to begin lowering interest rates at some point later this year, explicitly saying in the remaining 4 interest rate setting meetings, which would include the next meeting in July. When asked if the Fed would begin already cutting rates had it not been for tariffs, Powell had this to say.
I think that's right. In effect, we went on hold when we saw the size of the tariffs and essentially all inflation forecasts for the United States went up materially as a consequence of the tariffs.
Powell reiterated that the Fed has not seen much of an impact yet from tariffs on inflation, noting that the central bank expects to see, quote, some higher readings on inflation, but that officials are prepared to learn and that inflation could be higher, lower, later, or sooner than expected. Powell has roughly 10 months left in his term as chair. And when asked what keeps him awake at night, he says he wants to turn over an economy to a successor that is in good shape. Asked whether he would remain on as a Fed governor after his term ends as Fed chair next May, Powell said, I don't have an answer for you today. Josh?
Thank you, Jen. Jay Powell says, listen, we could have been cutting if not for those Trump tariffs. What do you make of that when you heard that?
I mean, I completely agree in the sense that we don't know right now what the impact of tariffs on inflation is going to be just yet. And something that stood out to me that Powell reiterated in Sintra was the fact that it's going to take a few months for that to show up. So if anything, it's derailed the Fed's progress towards moving towards more neutral territory sooner rather than later. And we think they're still going to have to remain data dependent. Either way, the trade backdrop is going to put upward pressure on inflation, and we have to see what's going to happen there before they can go ahead with their cuts.
Do you think, Carrie, that investors might be looking through Powell at this point? What I mean is that his tenure's coming to an end next spring, and Trump is no fan of Powell. He's going to, I think, nominate someone who may be closely aligned with his views, his perspectives. Do you think investors may be looking already post-Powell?
That's a great question. And I mean, what I'm thinking about right now is the inflationary forces at play. And I think either way, if history is any precedent, we think that the labor side of the mandate is probably going to bear more weight than the inflation side of the mandate. Having said that, we know there are significant inflationary headwinds at this point in time. So our expectation is actually we think that the Fed will be in a place to cut rates in the fall, but we don't think they're going to have sufficient evidence that that's a permissible move by the time the July meeting comes around. Because if you think about it, we haven't seen the impact of tariffs fully show up. We're waiting to see that play out. On the labor market front, we have seen some weakness in the services sector, and that's something I'm interested in seeing in this Thursday's NFP print. So our expectation is that we think there will be 106,000 jobs added to the U.S. economy in June, a little bit weaker than May's 139,000 print, but we're starting to see some evidence of an erosion in the services sector outside of healthcare, and we saw that with the GDP revisions last week. Services sector consumption was up only 0.6% on a quarter-over-quarter annualized basis. That's the weakest that we've seen since the pandemic. And while one quarter doesn't make a trend, I'm curious after the PCE prints last week to see how that plays out in the labor market data this week, because we saw a pullback in retail last month. We could start to see that again. Transportation and warehousing has been hit by tariffs. And so, it's really looking like the labor market has lost momentum, or at least it's slowed down from where it was last year.
So cooling, not crashing.
Exactly.
On tariff inflation, it's so interesting to me, Carrie, because we're waiting for tariff inflation. And Jay Powell, when we last, he says he's waiting for it, and he's very interested to see how it actually susses out, who pays for it. Is it Carrie and Josh, or is it a producer or a seller? What are the chances, as an economist, that the tariff inflation boogeyman actually never shows up?
I think the chances are pretty low. I mean, it's very unrealistic that the producers are going to be able to fully absorb these costs. And they've indicated themselves that they don't have sufficient profit margins to fully absorb these costs. And so we think that they are going to start to be passed off to consumers. Now, last month's inflation data, we didn't really see any signs of this just yet, though I will mention that motor vehicle parts and equipment did tick higher. Again, 1 month doesn't make a trend, so we're going to have to see how that plays out. But definitely we do expect it to start showing up. But it takes a few months, right? Because we saw a build in inventories. So those products are going to shelves. People aren't paying those higher prices just yet. But we do expect likely by the end of the summer, we'll have an idea of what that's going to look like.
So the Kerry Freestone call for Fed cuts this year, how many, Kerry, and when do you expect they start?
So we expect 3 cuts this year and 3 likely next year. So we have cuts starting in the fall right now. But again, that does depend on how the inflation picture prevails.
So Lou, Kerry says 3 cuts this year. Does that align with Lou Bassinet's call?
Yeah, I'm not the economist, but I have been an outspoken not cut yet. But I'm with you. July's too soon. I think what's interesting is we're waiting for Godot in the tariff inflation numbers, right? Like we haven't seen it yet. Does it show up? Powell's getting this indefinite hold. He's playing diplomatic. So I think, for me, everyone's acting as if we're on this perfectly balanced seesaw. If we put 25 basis points over here, it's going to tip one way. It's really not that precise. So I think it's more to your point. When do they start? When does the data justify the cut starting? I could see 1 to 2 by the end of this year, barring some change in the data. But I definitely think we're not going to where the president wants, to ZERP, like he mentioned yesterday and heading into here. But I think everyone's focused on when's the trajectory starting to go down again.
Kerry, finally, I'd be remiss if I didn't ask you about the big, beautiful bill. Senate passes it, goes to the House, of course. Elon Musk not happy about it one bit, right? He's on X, and he is bringing up concerns, Kerry, that a lot of folks do, including some members of the House. Worries about the fiscal challenges, debts and deficits. I'm just curious, as an economist, how do you see that bill?
So when I'm thinking about the bill, I mean, we have the TCJ extension. That's already been baked into our forecast. So at this point, that's not necessarily going to boost consumption. It's just a continuation of the status quo. What's interesting to me is, we have these Medicaid cuts, and we also have an increase in the SALT cap deductions. And so what that means is we're in a situation where we're transferring purchasing power away from lower income consumers towards higher income consumers. And it is those higher income consumers that typically drive the hard data. One thing I want to keep in mind, though, is the fact that higher income consumers do have a higher propensity to save. So just because they have that extra money in their pocket doesn't mean they're spending it. And it's interesting because right now we've seen, again, some weakness in the services sector, specifically in transportation services, accommodation, and food services. That's where wealthier folks spend their money. So I'm worried that this group may be stuck in uncertainty paralysis and maybe a bit spooked in ramping up their savings. So I don't know whether, this bill, once it's passed, is actually going to move the needle when it comes to consumption, or if everybody's just worried about, this uncertainty that we're facing.
So maybe they're worried, Kerry, but I wonder, when you look at the market and the run we've had and you're back at records, the wealth effect for those folks too. How does that variable factor in?
Absolutely. I mean, that really is kind of the driving force behind why we've seen a deviation in the soft data and the hard data. The sentiment data has eroded, but to date, there hasn't been a significant erosion in the hard data. Started to see signs, but not a material erosion just yet.
Kerry, always great to see you, especially on set. Thank you.
Again.